72 hours ago, a document emerged from the trading floor of Morgan Stanley. 3 paragraphs, 300 words, and one directive that changed everything. Exit all positions. Not reduce, not hedge, not rebalance. Exit. A $2.3 trillion institution telling its most elite clients to abandon silver entirely by month's end. When the smartest money in the room runs, they've seen something the rest of us haven't. The question isn't whether the ship is sinking. The question is, how much time is left before the water reaches your deck? Welcome to Currency Analyzer. Now, before we dive into what Morgan Stanley knows that you don't, let me ask you something. You know how your grandfather used to say, listen carefully when the wise men whisper? Well, today we're listening to whispers from the most powerful trading desks on Wall Street. But here's the thing. If you want to keep hearing these whispers, if you want to stay ahead of what's coming, do something simple for me. See that subscribe button? Press it. Like you're securing your position before the market opens. And tell me, where are you watching this from right now? New York, London, Mumbai, Lagos? Drop your city in the comments. Because what's about to unfold, it affects every corner of the global economy. Now, let's decode this memo. The memo arrived on a Tuesday morning, not through official channels, not through press releases, not through the polished communications that banks send to reassure markets. It came through encrypted internal systems, from Morgan Stanley's commodity trading desk, directly to a select group of institutional clients, the kind of clients who move markets with a single phone call, hedge fund managers, sovereign wealth fund directors, family offices managing generational wealth. People who don't panic easily. But this memo, it was different. 3 paragraphs, approximately 300 words, and buried within those words was a directive that seasoned traders described as unprecedented in modern banking history. Exit all positions in silver derivatives and physical holdings. Complete liquidation required before month end, no exceptions. In the world of institutional finance, language matters. Every word is chosen with surgical precision. Every phrase is vetted by legal teams. Every directive is measured against potential market impact. Banks don't use words like exit casually. They say rebalance when they want clients to adjust portfolios. They say reduce exposure when risk levels are elevated. They say consider alternatives when they're worried about a sector. But exit? Exit means something entirely different. Exit is what you hear when the building is on fire, when the structural supports are failing, when staying inside means you don't get out alive. Morgan Stanley, a financial institution managing $2.3 trillion in client assets, was telling its most sophisticated investors to abandon the silver market completely. Not next quarter, not when market conditions improve, not gradually over time, now, before the end of this month. The memo's existence was first confirmed by 3 separate sources within the institutional trading community, all speaking on condition of anonymity, all describing the same document, all conveying the same sense of urgency from Morgan Stanley's leadership. One source, a derivatives trader with 15 years at a competing investment bank, described the memo as the kind of communication you see maybe once in a career. Another source, a portfolio manager at a major hedge fund, said his team spent an entire day analyzing what could trigger such an absolute directive. A third source, someone with direct access to Morgan Stanley's commodity desk, simply said they've seen something in their risk models, something big, and they're not waiting around to see if they're right. This wasn't a suggestion. This wasn't investment advice wrapped in careful disclaimers. This was an evacuation order. Morgan Stanley operates one of the largest commodity trading operations in global finance. They have access to proprietary data that retail investors never see. They run risk models that cost millions to develop and maintain. They employ some of the most sophisticated quantitative analysts in the industry. When an institution like this runs, it's not because of rumors. It's not because of speculation. It's not because someone had a bad feeling. It's because their models, their data, their analysis all pointed to the same conclusion. Staying in silver positions represented unacceptable risk, the kind of risk that could wipe out years of profits in a matter of days. The memo included specific instructions for execution, how to unwind positions without causing immediate market panic, which counterparties to prioritize, how to manage the inevitable losses from rapid liquidation. Because, make no mistake, when you exit positions this quickly, you take losses. You accept unfavorable prices. You pay premium costs to break contracts early. You sacrifice potential gains for certainty of exit. Morgan Stanley knew this. Their clients knew this, and they did it anyway. That's what made this memo so extraordinary. The bank was willing to absorb significant financial losses, to damage their market position, to potentially face questions from regulators and shareholders, all to get out of silver before something happened, before something they had identified, something they had quantified, something they had determined was coming soon enough that waiting even one additional month was too dangerous. The document itself remained internal. marked with classification headers, distributed only to those who needed to know. But in the world of institutional finance, secrets don't stay secret for long. Information flows through back channels, through trading floor conversations, through encrypted messages between counterparties. And slowly, quietly, the word began to spread. Morgan Stanley was running. The question everyone was asking wasn't whether the memo was real. The question was, what did they see that made running the only rational choice? Most people think they understand silver. They picture coins, jewelry, maybe some industrial uses in electronics. But what exists beneath the surface, what operates in the shadows of global finance, is something entirely different, something far more complex, far more leveraged, and far more dangerous than most investors could imagine. The global silver market isn't just a market. It's a carefully constructed illusion. On paper, the silver market appears orderly, liquid, functioning exactly as markets should. Approximately $1.2 trillion in physical silver exists worldwide, sitting in vaults, in industrial inventories, in government reserves, and private collections. But that's just the foundation. Built on top of that foundation, layer upon layer upon layer, is a derivative structure so vast that the physical metal backing it represents less than 1% of the total claims. Think about that for a moment. For every actual ounce of silver that exists in a vault somewhere, there are potentially 250 paper claims saying, I own this silver. 250 people, all holding contracts, all believing they have legitimate ownership, all certain that when they need to convert their paper into metal, the metal will be there. This is what traders call fractional reserve commodities trading. And it works, right up until the moment it doesn't. Silver serves two masters in the modern economy. 60% of annual silver demand comes from industrial applications. Real businesses making real products that require actual physical metal. Electronics manufacturers need it for circuit boards. Solar panel producers need it for photovoltaic cells. Medical equipment makers need it for antimicrobial properties. Automotive companies need it for electric vehicle components. These aren't investors speculating on price movements. These are factories with production schedules, supply chains with delivery deadlines, contracts with penalty clauses for non-delivery. They need physical silver, and they need it on specific dates, or their operations shut down. The remaining 40% comes from investment demand. It's exchange-traded funds holding silver on behalf of retail investors, institutional positioning through futures contracts, sovereign nations building strategic reserves, wealthy individuals seeking inflation hedges. But here's where the architecture becomes unstable. For 3 consecutive years, global silver consumption has exceeded new mining production. The deficit grows larger each year. In 2023, the world consumed 92 million ounces more silver than miners extracted from the ground. In 2024, the deficit expanded to 108 million ounces. Projections for 2025 suggest the gap will widen further, potentially reaching 130 million ounces. So where does the extra silver come from? Recycling provides some, maybe 20% of annual supply. Government stockpile releases provide occasional relief, but mostly the deficit is being filled by drawing down existing inventories. Vaults that were full 5 years ago, slowly emptying, and nobody knows exactly how much remains. The London Bullion Market Association, the primary physical silver trading hub, doesn't publish real-time inventory data. The Shanghai Gold Exchange, the largest physical precious metals exchange in the world, releases information with significant delays. COMEX vaults in New York, where much of institutional silver trading settles, show registered inventory levels that fluctuate wildly month to month. This opacity creates opportunity for banks like Morgan Stanley. They trade silver futures contracts, derivatives that promise to deliver physical metal at a future date, without necessarily holding the physical metal today. It's profitable when markets are stable. A bank can sell 100 futures contracts, collect premiums and trading fees, and as long as most contracts settle in cash rather than physical delivery, they never need to actually produce the metal. It's financial alchemy, creating value from nothing, as long as confidence holds. But confidence is a fragile thing, and when industrial demand keeps rising, when investment demand accelerates, when inventories keep falling, the mathematics of fractional reserve trading begins to break down. Imagine a bank that holds 10,000 ounces of physical silver in their vault. Under normal operations, they might sell futures contracts representing 50,000 ounces, maybe even 100,000 ounces. As long as only 10% of contract holders actually demand physical delivery, the bank is fine. They deliver from their vault, settle most contracts in cash, pocket the difference. But what happens when 20% want delivery, or 30%? Or, in a worst-case scenario, what happens when everyone wants delivery at once? This is called a delivery squeeze, and it's exactly what Morgan Stanley's risk model started showing. The February 2021 nickel crisis on the London Metal Exchange provided a preview. A Chinese company had massive short positions in nickel, betting prices would fall. Instead, Prices doubled in 48 hours as buyers demanded physical delivery. The exchange, facing systemic collapse, simply stopped trading. They canceled trades. They rewrote contracts. They changed the rules mid-game. Billions of dollars in positions evaporated overnight. Institutional credibility shattered. Morgan Stanley watched that crisis unfold. They studied the mechanics, the trigger points, the cascade effects. And somewhere in their analysis, they recognized the same pattern emerging in silver. A market where paper claims vastly exceeded physical availability, where industrial demand was accelerating beyond supply capacity, where investment interest was growing among precisely the wrong type of buyer. The type who doesn't settle in cash, the type who demands delivery. September 14th, 2024. A date that meant nothing to most people, but in the quiet corridors of central banking, in the risk management departments of major financial institutions, this date represented a fundamental shift in how the game was played. Basel III regulations, years in the making, finally reached full implementation for precious metals holdings. The technical details seemed boring to outsiders. Regulatory capital requirements, net stable funding ratios, liquidity coverage standards, words that make eyes glaze over. But beneath that bureaucratic language, beneath those accounting adjustments, was a simple reality that changed everything. Banks could no longer treat paper silver the same as physical silver on their balance sheets. Unallocated positions, the derivatives, the futures contracts, the leveraged bets that had powered decades of profitable trading, suddenly required significantly more capital to maintain. Physical silver in a vault that still counted as a Tier 1 asset, but paper claims on silver that didn't exist, those now carried risk weights that made them expensive, sometimes prohibitively expensive, to hold. Most banks began adjusting months earlier, quietly reducing positions, unwinding leverage, bringing their exposure ratios into compliance. But Morgan Stanley had waited, not out of negligence, not out of incompetence. They had waited because unwinding too early meant leaving profits on the table, meant signaling weakness to competitors, meant potentially triggering the very market disruption they were trying to avoid. They had calculated they could wait until November, maybe even December, before needing to act. Then something changed. In the third week of October, 3 separate industrial conglomerates, major manufacturers with extensive supply chains, approached precious metals dealers with unusual requests. They wanted to convert their existing paper-silver positions into physical delivery, not eventually, immediately. One was a solar panel manufacturer based in Germany, facing production delays due to supply chain uncertainties, deciding that holding physical inventory was worth the storage costs. Another was a South Korean electronics firm, worried about geopolitical tensions affecting Asian shipping routes, preferring to secure metal now rather than rely on just-in-time delivery. The third was an American defense contractor, responding to new Pentagon requirements for critical materials, stockpiling, needing verifiable physical possession rather than financial proxies. Individually, each request was manageable. Collectively, they represented something Morgan Stanley's analysts recognized immediately, a pattern shift. For decades, industrial users had been content with paper positions. Financial instruments that promised delivery when needed, that could be traded easily. That didn't require expensive vault storage. But now, sophisticated institutional buyers, companies with experienced procurement teams and detailed risk assessments, were deciding that paper promises weren't good enough anymore. They wanted the actual metal. Morgan Stanley's quantitative team ran the scenarios. If this represented a broader trend, if even 10% of current paper holders decided they wanted physical conversion over the next 6 months, the numbers didn't work. There simply was not enough available physical silver to meet simultaneous delivery demands without prices spiking to levels that would trigger margin calls, force liquidations, potentially collapse the entire derivative structure. But the Basel III deadline created a second problem. Under the new regulations, maintaining large short positions in silver derivatives required holding significantly more capital in reserve, capital that could be deployed more profitably elsewhere, capital that, if locked up in increasingly risky positions, exposed the bank to potential losses that could ripple across other business lines. The Risk Management Committee ran stress tests. Scenario 1, orderly unwinding over 6 months, accepting moderate losses, minimal market disruption. Scenario 2, rapid exit over 30 days, larger immediate losses, but eliminating tail risk exposure. Scenario 3, maintain positions and hope the delivery demand was temporary, potentially catastrophic losses if the trend accelerated. They chose Scenario 2, not because it was painless, because it was survivable. The memo went out 72 hours after that decision, but Morgan Stanley wasn't operating in a vacuum. Every major bank with significant precious metals exposure was running similar calculations, seeing similar data, facing similar regulatory pressures. The difference was timing. Morgan Stanley moved first. And in the world of institutional finance, moving first during a crisis provides exactly one advantage. You get out while there's still liquidity. You exit while counterparties still have capital to absorb your positions. You liquidate before everyone else realizes they need to liquidate too. Because once the second major bank announces they're exiting silver, once the third bank follows, once the market recognizes this isn't one institution's isolated decision, but a systemic repositioning, the exits get crowded very quickly. History provided clear precedent. March 2020. Now, when COVID lockdowns began, every bank simultaneously tried to reduce risk exposure. The corporate bond market, normally liquid, froze completely. Spreads blew out to levels not seen since 2008. The Federal Reserve had to intervene with emergency lending facilities just to keep the system functioning, or go back further. September 2008, when Lehman Brothers collapsed, every institution tried to pull back from interbank lending at once. The overnight lending market, the very foundation of banking operations, simply stopped working. Banks with adequate capital couldn't access basic operational funding because nobody trusted anyone. The silver market was smaller, less systematically important than bonds or interbank lending, which meant it was more vulnerable, not less. Because when crisis came, there would be no Federal Reserve backstop, no emergency lending facility, no government guarantee, just institutions scrambling to exit, and whoever was left holding positions when the music stopped. Morgan Stanley's memo acknowledged none of this publicly. The official language remained clinical, procedural, routine risk management, but the traders who received it understood. The rats were leaving the ship, not because they heard the captain say, "Abandon vessel," but because they felt the deck tilting beneath their feet, and they knew, absolutely knew, that the water was already rising below. The leaked memo created an invisible divide. On one side, those who saw it, understood it, and acted accordingly. On the other side, everyone else, still operating under the assumption that markets function normally, that institutions behave rationally, that tomorrow will look roughly like yesterday. This gap, this asymmetry of information, represents the most valuable commodity in modern finance, not silver itself, but knowing what the institutions know before the rest of the market figures it out. For institutional investors, the implications are immediate and uncomfortable. Anyone holding significant silver exposure through derivatives, futures contracts, unallocated positions with major banks, they face a question with no comfortable answer. If Morgan Stanley is exiting, and if other banks follow, who becomes the counterparty to existing contracts? Derivatives don't exist in isolation. Every long position has a corresponding short position. Every buyer has a seller. When major banks exit their short positions, they're essentially buying back contracts they previously sold, pushing those obligations onto whoever is willing to take the other side. But at what price? And more importantly, with what assurance that the new counterparty can actually deliver if physical settlement is demanded? The memo didn't just signal Morgan Stanley's exit, it signaled a potential restructuring of the entire counterparty network in precious metals derivatives. Some hedge funds began quietly reaching out to their prime brokers, asking technical questions about contract assignment, about novation processes, about what happens if a major bank liquidates positions faster than the market can absorb them. The answers they received were unsettling. In normal market conditions, banks can unwind positions gradually, matching sellers with buyers, maintaining orderly price discovery. But when everyone knows a major institution is desperate to exit, when the deadline is public knowledge, when other institutions might follow, normal market conditions cease to exist. Price discovery becomes price extraction. Every counterparty knows Morgan Stanley needs to sell, which means every counterparty can demand a premium for taking those positions off their hands. This is how orderly exits become disorderly losses. For businesses that actually use silver, the strategic calculus is different, but equally urgent. A solar panel manufacturer in Nevada, a medical device company in Massachusetts, an electronics firm in Taiwan, they all rely on stable silver prices and reliable supply chains. If institutional liquidation drives short-term price volatility, if physical delivery becomes constrained, if the gap between paper prices and physical availability widens, their production costs become unpredictable, their supply contracts become unreliable, their profit margins disappear. Some companies began exploring alternatives immediately. Could they substitute other materials in their manufacturing processes? Could they hedge through longer-term physical purchase agreements? Could they build inventory buffers large enough to weather potential supply disruptions? Each option carried costs. Each option required capital allocation decisions. Each option needed to be implemented before the broader market recognized the same risks. Because once silver supply concerns become mainstream knowledge, once industrial buyers start competing for limited physical inventory, prices reflect panic, not fundamentals. But the most sophisticated actors, the ones who truly understood what Morgan Stanley's memo represented, they weren't asking whether to exit silver. They were asking whether this represented an opportunity. Institutional panic creates predictable patterns. Forced selling drives prices below intrinsic value. Leverage unwinds, create temporary liquidity gaps. Counterparty repositioning generates pricing inefficiencies. For investors with patient capital, with no forced liquidation deadlines, with the ability to hold through volatility, other people's panic becomes their opportunity. The key distinction, the critical analysis, was separating short-term institutional mechanics from long-term fundamental value. Morgan Stanley wasn't exiting because silver lost its industrial utility. They weren't exiting because solar panels stopped needing silver, or electronics manufacturers found cheaper alternatives, or investment demand disappeared. They were exiting because their specific risk models, under specific regulatory constraints, with specific leverage ratios, made holding those positions untenable. That's an institutional problem, not a fundamental problem. History shows this pattern repeatedly. 2008, institutional panic forced sales across corporate bonds, driving prices to levels that implied bankruptcy rates far exceeding reality. Investors who bought during the panic, who had capital when institutions were liquidating, made generational returns. March 2020, institutional deleveraging hit commodity markets indiscriminately. Oil briefly traded negative. Natural gas collapsed. Precious metals sold off despite obvious safe haven demand. Buyers who understood the mechanics, who separated temporary dislocations from permanent impairments, positioned themselves ahead of the recovery. The Morgan Stanley memo represented the same dynamic playing out again. Institutional constraints forcing actions that create temporary market dislocations that sophisticated actors can exploit. But exploitation requires knowledge. Knowing that Morgan Stanley is liquidating, that's valuable. Knowing why they're liquidating, that's more valuable. Knowing what happens after they finish liquidating, that's where strategic advantage lies. Because the memo had an end date, month's end. After that, Morgan Stanley's positions are gone, their forced selling stops, the institutional pressure that drove prices down dissipates. What remains is the underlying reality. Industrial demand still exceeds mining supply. Inventory drawdowns still continue. Basel III regulations still make leveraged paper positions expensive for all banks, not just Morgan Stanley. The fundamental tension that triggered this crisis, the gap between physical availability and paper claims, that doesn't resolve just because one bank exits. It intensifies because every other bank with similar positions, similar regulatory constraints, similar risk models, they're watching Morgan Stanley liquidate, they're seeing the market impact, they're calculating their own exposure, and they're asking themselves the same question Morgan Stanley's risk committee asked. Can we afford to wait? The answer, for at least some of them, will be no, which means the liquidation cycle continues, which means volatility persists, which means the divide between those who understand what's happening and those who don't grows wider with each passing day. The memo wasn't the end of the story, it was the opening chapter. A warning written in the language of institutional risk management, a signal that the architecture beneath the silver market, the derivatives structure, the fractional reserve system, the paper claims on physical metal, was beginning to crack, not catastrophically, not all at once, but crack by crack, position by position, institution by institution. The foundation was giving way, and when foundations crack, you have two choices. You run from the building, or you wait for it to collapse, and buy the rubble at a discount. The question each market participant faces isn't whether Morgan Stanley made the right decision. The question is, what decision makes sense for their specific situation, their specific timeline, their specific risk tolerance, but that decision, that choice, it requires knowing what Morgan Stanley knew, understanding what their models showed, recognizing what comes next. The memo provided that knowledge to those who received it, to those who understood it. And now, to those paying attention, the invisible divide just became visible